Hello, this is Jody Trana. Welcome to Chapter 1, Part 1 of Principles of Accounting, ACCT 211. I wanted to show you a great way to get some help from me while you are working in my lab. When you have a problem in homework and you want to get some answers from me, the best way to do it is to click on Question Help and ask my instructor. What this does is sends me an email and it lets me know exactly which question you have been working on. This is particularly important as it gets to be more complicated assignments so that I can see the point where you're at. I can also see the answers that you've had up to that point where you had some difficulty. So then I can get my answers back to you are going to be a whole lot more useful to you. For each homework problem that you have in my lab, you have an opportunity to redo it. Down in the lower right corner, you see a button that says Similar Question. You will always see a button here. It'll either say Try Again or Similar Question. And if you press that, you'll get an opportunity to redo that homework and improve your score. Accounting is just like scorekeeping for sports. In accounting, we have systems for doing it so that we can track the information that we need. In business, we're trying to figure out if we won the game or if we didn't, and why we won the game or why we didn't. So there are different things that we track, just like we would track certain things if we were keeping score for a basketball game or a football game. I briefly want to mention that businesses all have a legal structure, and this has to be determined by the company based on what their needs are. The easiest form of legal structure is the sole proprietorship, which is usually identified as a small business with one owner or a partnership with multiple owners. In our exercises and the first part of Principles of Accounting, we are going to be solely learning about the sole proprietorship and how we do accounting for that legal structure. You're going to hear a lot about GAAP in this semester. GAAP stands for Generally Accepted Accounting Principles. Think about football teams for a second. What if the football teams on the West Coast had different rules than the football teams on the East Coast? Even if they played in completely different leagues, it'd be really difficult for us to compare two teams from either coast. They're operating under different rules. So we need to have common rules, and the same thing is true in comparing businesses. We need to be able to review financial information and know that that financial information kept accounting under some specific principles. So let's go through these four just today. First, the economic entity assumption. This assumes that the business's accounting is kept separate from the owner's accounting. That may seem logical, but many times when businesses get first started by the founders, there is a very gray area between what the founder owns and what the business owns. So those need to be kept separate. Second, the cost principle. This states that everything in accounting needs to be recorded based on how much an item cost, not what its market value is. Third is the going concern assumption. This states that we assume that the company has no expiration date. It is just going to operate on into the future with no foreseeable end. And fourth, the monetary unit assumption. This states basically that we measure all of our money in a monetary unit. I know it seems obvious, but we need to have these principles just to make sure that everybody's doing things the exact same way. In the United States, that means we use the dollar. We cannot take advantage of of foreign rates just to make our financial statements look better. If you were to explain a game like baseball to someone who had never watched baseball, you'd need to explain the players, the rules of the game, and you'd also need to explain some of the terms like hit, strike, and home run. In business, we have many terms that you need to learn. Some of them are the account categories. We have assets, liability, equity, revenue, and expenses. I'm sure that you've heard these words before, and we'll watch a few video clips here to prove it. Here's a brief review of the account categories you'll find in the accounting system. Every transaction affects at least one of these categories. They are assets, liabilities, equity, revenue, and expenses. You saw in the previous movie clips assets, liabilities, and equity. So let's review those first. Assets are things with value owned by the company. The reason we own assets is that they are expected to grow the business and to bring in more revenue. Liabilities are others' rights to that value in the company. So assets have value, and people outside the company have maybe loaned us money or provided us with things that we haven't paid for yet. We have an obligation to them, so they have rights to the value in our company. Equity are the owner's rights to the value in the company. When we earn more money, when we put in more money as a cash contribution, our rights to the value of those assets increase. The other two accounts, revenue and expenses, indicate the money that we earn and the money that we spend for our regular course of business. The reason that these are in two different colors is to indicate which report these categories are shown on. Assets, liabilities, and equity are combined to show on the balance sheet, and revenue expenses are both put onto an income statement. Of the 5 terms that we just reviewed, one of them is not shown in this word cloud. See if you can figure out which one it is. And while you're reading through these, just count on seeing these terms again. Finally, just a look at the accounting process. In business, transactions happen. Usually, when a transaction happens, money exchanges hands, but not always. When a transaction happens, that transaction needs to be recorded in the accounting system. Accounting categories are determined, such as cash and inventory, and information is entered into an accounting system in order to generate reports. The reports that come out tell us how well the company has done, how much ownership there is, how many assets there are. It gives us an indication of the performance of the company and the profitability of the company. We need these reports in order to pay taxes, in order to borrow funds from a bank, in order to plan for the future. So there's a lot of uses for these reports. There are people inside the company who need the reports, and there are people outside the company like the bankers, lenders, investors, and also the IRS that need our information. So we want to make sure that we understand the process and are able to do it quickly, efficiently, and correctly.